In the alternate version of exercise 420, we're using the same 3 transactions we used earlier in exercise 47, but we're switching things up a bit, and instead of using a perpetual inventory system, we're going to record these entries with using a periodic inventory system. We're still going to start out with the buyer's journal entries from Sydney Retailing, and on May the 11th, we're going to jump into recording the purchase of $50,000 worth of goods from Troy. Same terms of 310 net 90 and FOB shipping point. Those details have not changed. If you remember, under the perpetual system, we debited merchandise inventory because we reflected any increases and decreases. So at any point in time, the amount of inventory in our balance sheet reflected the true amount of goods available for sale. That's what we do under the perpetual system. We don't do that same tracking of inventory under the periodic system. At any point, the balance in merchandise inventory is the beginning balance or last year's ending balance, and so it doesn't reflect a current balance of what goods are available for sale. Now the question may be, well, so when I make a purchase, do I just not make a journal entry? Because it sounds like I can't debit merchandise inventory. Well, you can't do that because we still have had some type of financial obligation occur. We've made a purchase as far as Sydney, and we have an outstanding obligation, so we still need to affect accounts payable in some way, and we've got to have a balanced journal entry, right? So we've got to have a debit. So we create a new temporary account called purchases. Again, we can't debit merchandise inventory because we don't reflect the increases and decreases. Purchases is a temporary account. It's not an asset, it's not a revenue, it's not a liability, so it doesn't fit with any categories we've talked in the past. It truly is the cost of any purchases, inventory purchases, for a company using a periodic inventory system. We increase it with a debit. So we'll debit it for $50,000, the cost of the inventory. Although it doesn't fit within the classification of a liability, a revenue, and equity, it functions somewhat like an expense in that it's going to be increased with a debit. Again, not truly an expense, but it's going to be increased with a debit. Like the perpetual system, we will still credit accounts payable by increasing liability, crediting it for $50,000, and notate this is a purchase of merchandise on credit terms 310, not 90. You may also recall from our perpetual system that we had $500 worth of cash that we're going to pay to Express Shipping. Remember, the terms are FOB shipping point, so it is Sydney's responsibility to pay for those items. Well, truly this is an additional cost related to the merchandise inventory. Recall from our earlier scenario when we bought the inventory itself, we can't debit merchandise inventory. So similar, our freight charges here, we can't debit merchandise inventory directly. So instead of using the purchases account, which we tend to only use for what we're paying directly to, or what we owe directly to the vendor that we purchase the items from, we're going to use a new temporary account called Transportation In. Some companies know this by a different name. Some treat it as Freight In. This is freight, inbound freight related to inventory items. It's again a temporary account like purchases. It's increased with a debit, so we'll debit it by $500. The credit side doesn't change. Now we're using the periodic system. We're still going to credit cash for $500 and notate that we paid shipping charges. On the 12th, Sydney is going to return part of these goods. So somewhat like what we did in the perpetual system, we'll go up and reverse a portion of our original entry by debiting accounts payable for $4,000. And instead of crediting purchases directly, we'll credit what's called a contra purchases account called purchases, returns, and allowances for the $4,000 in cost. It's contra purchases account because it's related to purchases, but it subtracts from it, so it has opposite the normal balance. It's going to be increased with a credit. Somewhat like if you recall sales and sales returns and allowances, the question might be, why have two separate accounts? It's so we can isolate what has been invoiced directly from the vendor or supplier versus what have we returned, so we can track those two different items separately. Now we'll move on to the 20th, and we'll look at our payment from Sydney to Troy of the overall amount owed. Our overall accounts payable originally started at $50,000, but then we had a return of $4,000, leaving a net $46,000 left in accounts payable that we're going to debit. On the other hand, we have a discount because if you recall, we pay within the 10-day discount period. Originally invoiced on the 11th, paid within the 20th. It's a 3% discount, so we take $46,000 times 3% or 0.03, gives us $1,380. Under the perpetual system, we credited merchandise inventory because again, we show the increases and decreases at any point in time. We can't do that under the periodic system, so we use yet another temporary account, this one called purchases discounts. Again, we don't credit purchases directly to lower it, but we utilize another contra purchases account called purchases discount that's going to be increased with a credit of $1,380. And we round this entry out with a remaining credit to cash of the difference of accounts payable of $46,000 minus our purchases discount, our 3% discount of $1,380, leaves us with the remaining 97% of the bill being credited to cash for $44,620. Although I don't show the calculation here, if we wanted to determine the overall net cost of purchases, again net cost, we would take our gross purchases of $50,000, add in transportation of $500, that's an additional cost of the inventory, subtract out purchases, returns, and allowances, and also subtract out purchases discount, and that would provide us the true net purchase amount. Moving on to our seller side with Troy Company, we start out again going back to our original purchase and sale where Sydney purchased $50,000 worth of goods that originally cost Troy $30,000. Our entries start out the same between the perpetual and periodic system, where we'll first record the sale with a debit to accounts receivable of $50,000 and a credit to sales of $50,000. So no difference here. The big difference is there's no second entry under the periodic system. Perpetual, we've got to keep that running track record. So we've got to show a credit or decrease to merchandise inventory, and we've got to reflect the ongoing cost of the sales, which is an expense by debiting it. Under the periodic system, we don't show that continuous tracking of inventory, and we do not show the increases to cost of goods sold. In fact, cost of goods sold is something we have to calculate at the end, so we have no second entry. So therefore on the 12th, somewhat similar when we have the return, we're still similar to the perpetual system, going to debit sales returns and allowances, a contra revenue account for the overall $4,000 sales value of goods returned. And we're still going to credit accounts receivable for $4,000, but we do not have that second entry that we did in the perpetual system. The perpetual system, when there was a physical return, you've got to increase merchandise inventory for what was put back on the shelf. You also have to decrease cost of goods sold. Since we didn't reflect that originally when we sold those items, we also cannot do that when we have the sale. Moving on to May 20th, our receipt of cash is going to be exactly the same no matter if we do the periodic system or perpetual system, so I'll work through this fairly quickly. We've got an overall accounts receivable balance due of $46,000, so we'll lower it by crediting it. The original $50,000 invoice minus the $4,000 return leaves us $46,000. If you recall from our perpetual, we also have to factor in our sales discount. It was $46,000 owed, but they paid within the 10-day window, May 20th versus May 11th. So take 3% or 0.03 times 46,000. That's going to be 1,380. If you recall, it ultimately lowers sales because that's that much less cash that was received in, but instead of debiting sales directly, we debit the contra revenue account called sales discounts. Cash is recorded as a debit And the difference between $46,000 in accounts receivable minus the 3% discount of $1,380 leaves us with a debit to cash, or an increase to cash, of $44,620. We can also calculate that a different way. If there's a 3% discount, that means that 97% of the cash was ultimately received. So we can take 97%, or 0.97 times our 46,000, also to get an increase to cash of $44,620.